All right. Today, we're going to dig into a stock that has basically defied gravity, SanDisk. I mean, it's gone completely vertical, and it's created this fascinating puzzle for anyone watching the market. So, is this thing a rocket ship with a whole lot more fuel in the tank, or is it flying way too close to the sun? Let's dive in and try to figure it out.
I mean, just look at this chart. This right here is what we call a parabolic move. You know, the kind of chart that creates legends, but also breaks a lot of hearts. The story behind the company is incredibly powerful, but the chart itself, well, it's screaming a warning. So which one do you listen to? That's the conflict we're going to unpack right now. So let's start by just trying to wrap our heads around how absolutely extreme this move has been. The stock recently closed at $952.50, a price that honestly would have seemed impossible just a few months ago. And to put that into perspective for you, the stock has already delivered over 200% in year-to-date returns. But it's really the speed of this move that's so stunning. Yeah, this isn't some slow, steady climb. It's a straight-up explosion. And this is the multi-billion-dollar question, isn't it? Is this just a classic speculative bubble, fueled by pure hype and momentum? Or is there a powerful, fundamental shift happening under the hood that actually justifies this unbelievable move? Let's take a look at the bull case.
So, the whole argument for SanDisk is that this isn't the same company it was 5 years ago. It has managed to position itself as a critical, absolutely essential engine for the entire AI revolution. And you know what? That changes everything. You see, historically, SanDisk was what you'd call a classic cyclical stock. They made memory chips, right? And that's a commodity business that goes through these really brutal boom and bust cycles. But the story today is completely different. The market is now looking at SanDisk as an essential piece of AI infrastructure driven by long-term secular growth, not just the whims of consumer electronics cycles. And this shows you exactly why that story is taking hold. Just look at these earnings projections. In fiscal year 2025, the company made about $3 a share. But look what analysts are expecting. Nearly $40 next year, and potentially up to $100 the year after that. This is hyper-growth on a scale you rarely ever see. Let's just zero in on that jump from 2025 to 2026. We are talking about over 1,000% growth in earnings per share. In a single year, that is the AI supercycle in action. It's this period of just intense, sustained demand that's flipping the company from a slump straight into massive profitability. So you might be asking, how on earth do you value a company with that kind of explosive growth? Well, one of the best tools for the job is something called the PEG ratio. It helps us figure out if a stock's price is actually justified by its earnings growth. And a low number, especially anything under 1, suggests the stock might actually be cheap compared to its growth. And this right here is the punchline for the bulls. SanDisk's PEG ratio, even based on conservative estimates, is a shockingly low 0.34. So the crucial argument here is that even with the stock price rocketing towards $1,000, the valuation hasn't even caught up to the earnings explosion. The fundamentals suggest it could, believe it or not, still be undervalued. Okay, so the fundamental story is incredible, no doubt. But we have to come back to that chart, because in financial markets, there is a very powerful force that has a perfect track record: gravity. This is just one of those hard truths of the market. You see, while a great business can grow for decades, a vertical price chart like the one SanDisk has, well, that's a mathematical and psychological anomaly. It just cannot be sustained forever. There are no exceptions. Now, there are 3 core reasons why these moves always break down. First, you eventually just run out of new buyers. Second, the price gets stretched way too far from its historical trend. And third, sooner or later, the early investors decide it's time to take their massive profits off the table. Let's really focus on that second point, what we call the rubber band effect. If we look at the chart again, the price is way up here at $952. But the 50-day moving average, that's the orange line, is way down near 656. And the 200-day, the red line, which is like the long-term trend, is all the way down at 359. That huge gap, that's tension. Seriously, think of it just like a rubber band. The stock price has been stretched an incredible distance from its anchor points, which are the moving averages. And the further you pull that band, the more violent the snapback is going to be when it's finally released. The market calls this reversion to the mean. And believe me, it is one of the most powerful forces in all of finance. So, how do we put these two completely opposite pieces of the puzzle together? On one hand, you have a company with absolutely incredible fundamentals, and on the other, you have a stock chart that history tells us is living on borrowed time. This is the core dilemma. We have two conflicting truths, and they are both happening at the same time. The AI supercycle and the earnings explosion, that's real. But the warning from this parabolic chart is also real. And as an investor, you have to deal with both of those realities. And this right here is probably the most crucial distinction to make. When we say the parabola will break, we do not mean the company is going to zero. A stock coming down means a brutal, rapid correction. We're talking 30, 40, maybe even 50% or more. But, and this is a big but, if the fundamentals are real, that correction can create a new floor for the stock to eventually find its footing and start a much healthier, more sustainable climb. And so we're left with this final, powerful question. We know the pattern will eventually break. The company's growth is real, but the chart's warning is undeniable. So when that break finally happens, is it a total disaster that you should avoid at all costs? Or is it the opportunity of a lifetime? That, my friends, is the parabolic puzzle.